This is Alan Bush with ADMIS. In the stock index futures, we are seeing prices steady to a little bit higher. However, we did see some new historical highs in the S&P in the overnight trade, even though we do have the ongoing geopolitical tensions around the world, especially in Ukraine. We did have a couple of economic reports today, which did come in better than expected. The ISM manufacturing was stronger and construction spending also better. But it seems like the driver behind the strength in stock indices is the ongoing low global interest rate structure. And it appears now that several major central banks are likely to ease credit conditions further. And that would include the European Central Bank, the Bank of Japan, and the People's Bank of China are all on track for more accommodation for their banking systems. So nothing changing in our long-term view. We expect higher prices for stock index futures. Over in the currencies, the dollar index firming. This on the ongoing belief that the Fed will raise interest rates in the middle of next year. By the same token, the euro currency is at a 12-month low on the continuing beliefs that the ECB will be adding more accommodation to their banking system. So that basically is the double whammy, so to speak, for the euro currency, where U.S. interest rates are anticipated to increase and Eurozone interest rates are expected to continue to fall. So we would look for more pressure in the euro currency. Also seeing the Japanese yen substantially lower today on the growing belief that the Bank of Japan will be forced to add more stimulus to their economy. This is a trend I believe that will continue long term, so more the same we feel is likely for the yen. Expect further weakness. Over in the interest rate markets, after the 30-year bonds registered new highs for the move last week, in fact, we did see the 30-year bond at a 14-month high. Some profit taking coming in today. In fact, a lot of profit taking with some sell stops. However, we feel just another half point lower in the bonds is where support is likely to hold. So any breaks in the bond market, I think, is a buying opportunity. Still feel that the main trend is higher. Still feel that longer term it will be the 30-year bonds that lead to the upside. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.